let's just step back and have a look at what does the IRR actually mean. So what I've got here is there's our various calculations. I've just got an IRR proof here, just to make it easier to look at. I'm just going to hide these rows. So here's our cash flow, and what you'll see is we've obviously got our cash flows. That's the money that leaves us. This is the money that comes into us. What I've created here is a little bucket. So you'll see I've got an opening balance of 0. I've then pretended this is like me putting money into the bank. So I've taken 20,000 out of my pocket and put it into the bank. Here's the IRR calculation, which gave us the 50.57%. We've got our closing balance, which just adds those up. Next year's opening balance is that one, closing balance. And then what we're doing is we're working out how much do we earn on the outstanding amount. So you'll see this 10,500 is taking the opening balance and growing it at our IRR. In terms of the cash we receive, all this is then doing is taking the money out in exactly the same way as the project would give it to us. And what you'll notice is that 50.57% ends up growing and paying out, growing and paying out, growing and paying out, such that in the last year, the last payment, the 18,677, results in a 0. So theoretically now, if this was a bank account, the bank would now owe us nothing. They've paid us back our interest and our capital. And that's why IRR, it's quite useful to think about it as an investment in a bank account, because this number tells us what would a bank have to pay us so that these profiles end up with a 0 over the period we've built the IRR for. And this can be quite useful, especially for loan calculations where they are based on some sort of a set return, an expected IRR.